Hello. In this video, we're going to cover the key steps in setting up a limited company in order to buy and hold investment properties. Before we start, please remember to like this video and watch the message at the end from our channel sponsor, findukproperty.com. Now, I have a separate video that explains the pros and cons of owning investment property either personally or using a company. The summary of that video is that when buying low-cost properties for cash, 75% of buyers still use personal ownership. You should consider a company if you're using mortgages, are a higher rate taxpayer, or are building a large portfolio where the rent is not taken out of the company but reinvested in buying more, or you plan to pass properties to the next generation and want to reduce your inheritance tax. But it's a balance of factors, and you need to weigh the pros and cons in view of your particular circumstances. Now, if you do decide to buy under a company name, you will need to set one up. So how do you set up a company? I'm going to cover these main areas. What are your reasons or objectives for setting up a company? Who should set it up? The 10 key steps in setting up process. I will also discuss 4 ways to fund your company and add money to it, the process of buying property and building the portfolio, and 5 ways you can take money out of the company for pension income or other needs. And finally, we discuss family investment or smart companies for long-term inheritance planning. We look at how they work and their pros and cons. Let's consider the reasons why you're setting up a company and your overall objectives. In my experience, there are 2 main categories of investors. Most investors are looking at the medium term, which can still be 10 to 20 years or more. Their main aim is to grow their money, remain 100% in control, and take benefits themselves. At some point, they may exit and sell their properties. They normally set up a fairly standard company with ordinary shares and have themselves as directors and shareholders, or with their spouses. The second category are those who want to do all of that, but are also looking at the very long term and also want to pass their wealth to their children as they retire and pass away. For them, the family investment company is more suitable. So who should set up your limited company? There is some simple advice on the company's house page, so you can follow the instructions and set it up yourself for around £100. Or for a similar price, you can use any online company formation agent. They also have a simple online process for you to do this. However, if you're doing this for the first time, we would recommend an accountant, and we will recommend specialist property accountants if you wish to set up a family investment company. It's best to avoid services that set up a separate company for each property. The idea behind this is that when you want to sell the property, you sell the company, and then the stamp duty on the share transfer is less for the buyer. Now, theoretically, it sounds good and maybe okay for very expensive properties over, let's say, £1 million, but there is no real market for sale of such companies that own a single low-cost property. Property buyers normally want to buy properties and not companies. Now, we will briefly cover all these aspects and steps in the setup process. The name. Now, there's an online name checker on the company's house website. You need to check to ensure your name or your proposed name is valid and not like any other. Shareholders. Decide who will be the shareholders. This could be just yourself, but normally this is, say, husband and wife, but may also include children. If the children are less than 18, then best to give them less than 20% shareholding to minimize any issues with lenders. It's easier to get mortgages if you don't have minor children as shareholders. You can gift shares to children later as well, but there may be some capital gains tax to pay if the gifting is done many years later. Directors. Decide who will be the directors. There can be just one director, but typically this is husband and wife. The company's standard industrial classification or SIC code for property investment is 68209. The money injected as capital can be nominal, for example, £100, giving 100 shares, each with a value of £1. Most people select ordinary class of shares. These normally give dividend and voting rights in line with the percentage shareholding and grow in line with company growth. The alternative is alphabet shares, for example, Class A, Class B, or Class C. This enables the company articles to be amended to give different voting, dividend, and growth rights to each class of share, and are really needed if you want to set up a family investment company. Most clients select the standard model articles of association, but accountants can amend these to ensure the share classes are correctly set up. After setup, your company is registered and you get the registration number, company articles, certificates, and other documents from Companies House. You'll receive a letter from HMRC to your registered company address to provide them information and register online with HMRC. You or your accountant will need to do this. Now, you can open a company bank account with your existing bank where you have a personal account, but the online banks and services, such as these listed here, are quicker and can be done remotely. They're also easier than high street banks if the directors are not UK resident. The bank may ask for a simple business plan. For example, you have £100,000 savings in your personal bank account, which will be loaned to the new company as director's loan and used to buy one low-cost house for rental income. Once the company is set up, you have three main legal filing requirements. File the accounts with Companies House within 9 months of each company year end. File a corporation tax return with HMRC and pay any tax due. Annual confirmation statements with Companies House confirming the company officers. Your accountant can also do this for a reasonable fee. So these are the key steps to setting up your company. Now let's talk about how you will be funding your company. Most investors use one or more of these methods. Savings. Typically, clients may save up to, say, £100,000 from their business or salaries. They can inject this then into the company as directors or shareholders' loan. The company then buys the property with this money. Later, the investor can take back some or all of this loan without paying any tax, as it's their money. Buy-to-let mortgages. Some clients may have less funds, for example, £40,000. They inject this as director's loan into their company and get a buy-to-let mortgage of, say, £60,000 to acquire a £100,000 property. The rent is then used to pay back the mortgage. It's a good strategy when interest rates are low. Two-step process. This can be better than a mortgage as there is no interest or loan and hence no risk or approval process. The investor buys a very low-cost one-bedroom house for £40,000 and then switches or upgrades to a larger house when funds allow, example, after 3 years. It can work out around £10,000 cheaper than a mortgage to buy a property outright, and the company remains debt-free. See the Find UK Property website for details of this process. Funding from a trading company. Now, many investors who are wanting to build a portfolio already have a trading business. I have many clients who are doctors, dentists, IT professionals, and consultants. They have cash reserves in their trading companies and are high-rate taxpayers. And such trading companies can help fund their investment company in 3 ways. Firstly, they can take the money out and pay the high dividend tax, which for them may be 33.75% or 39.35%, and then invest as director's loan into the investment company. This isn't recommended as the tax paid is so high. Secondly, their trading company can simply loan the money to the investment company to buy properties. Now, eventually, the loan has to be paid off. Otherwise, some tax will be payable on this as the transfer could be treated as a personal dividend. Or thirdly, if they are likely to continue in this trading business for a long time, they can sell their trading business to the investment company. So the trading company becomes a subsidiary of the investment company, which becomes the owner. If the shareholders of the two companies are different, then there may be some capital gains tax to pay, on the initial share sale. But this would be a one-off payment, and it could be small if the current balance sheet value of the trading company is not huge. After this, any future transfers from trading company to the investment company are tax-free, and the trading company can continue to provide funding to grow the portfolio. For example, an IT professional can continue making profit in their trading company, pay corporation tax, and then take out any salary or dividends for their own use and transfer all the rest to the parent investment company to buy more properties to grow their portfolio. They would not need to pay dividend tax as the funds are transferred to the parent company. It's best to get advice from your accountant and get clearance from HMRC if needed before you do this. Now we'll talk about buying properties and building the portfolio. The buying process is the same as buying under personal ownership, and I have a video that explains the property buying process in detail and all the common questions relating to this. The company becomes the owner of the property. Rent is paid to the company. Company pays corporation tax, for example, 19%, or at a higher rate if the profits of the company are more than £50,000. The remaining rent can build in the company, and then the investor normally continues with his savings and adds more funds as director's loan or funds from their trading company in order to get another property. In this way, they gradually build a large portfolio for retirement and for passing on to their children. How can you take money out of the company? There are many ways of taking money out. The main requirement normally is pension type income when you retire, but there may be other reasons why you want to take money out. Interest on the loan. You can take fair interest, for example, 5% of your director's loan per year from the company, but this would then be classed as your income and taxed personally at your tax rate. If you're not resident and take interest on the loan you've given to your company, the tax may still be payable by the company. So this is not a popular option. Salary. Likewise, if you're not working, you can set up payroll and can also take a salary if you can justify that it's an active investment and not simply a passive investment. But again, most investors don't do this, as they will be taxed at their personal rate on the salary unless they have no other income. Taking back your director's loan. When you retire, or even before this, you can start taking income. Depending on your other income, you may wish to take back your director's loan first so that you don't not increase your total income and you remain a basic rate taxpayer. Taking out the loan would also reduce your inheritance tax liability. This is the most popular option if you need to take money out. Dividends. Later, when your loan is all taken out, you can start taking dividends and may pay tax. But by then, you may be a basic rate taxpayer and the dividend tax may be lower at 8.75% instead of 33.75%. Depending on your tax status, it can also be better to use a combination of dividend and loan when you take money out. Remember, if you're not UK resident, then you don't pay any tax on your company dividends in the UK. Your company still pays a corporation tax. Now, this is a great benefit, but you may have to pay tax in the country you live in, depending on where you live. But many countries, including those in the Middle East, have no income tax. So if you retire there and you're not UK resident, then you pay no tax on your UK dividends. Sell some properties. If you need some money and the company doesn't have enough cash to pay that, then you can sell some properties. This will release cash, but also generate a company profit, which may be taxed as there will be a capital gain. Now, as you get older, you need to assess your total assets and see if these are above or will be above the inheritance tax threshold, which is only £325,000 per person. You need to think ahead as properties grow and may double in value over 12 to 15 years and give you income, which also increases. So you may need to spend a lot more during retirement or do inheritance tax planning to leave wealth to children with minimal tax payable. This example shows a successful property portfolio growing to very high values over the long term. Now, with a couple, if one partner passes away and all the assets are transferred to the other, then inheritance tax is not payable at that point. It's payable when both are gone. In this example, over 1.6 million in inheritance tax may be payable by the children once both parents pass away. In my other video, I cover 3 ways in which you can reduce your inheritance tax, but each of these ways has some disadvantages. But the best way is to plan well ahead for the long term. So if it's likely that you're going to have significant assets, then using property accountants to set up a family investment company or smart company can help reduce inheritance tax. This could reduce tax by using 2 different classes of shares for the parents and for the children. The company accountant will give different rights to each class of share by amending the company articles of association. Parent shares are classified as Class A shares or freezer shares. These do not grow in value and have all of the dividend rights and voting rights, so parents retain control of the company and get all or most of the income, for example, as pension-type income. The children's shares are classified as Class B or growth shares. The capital growth only applies to the children's shareholding. They may have limited dividend or voting rights. A company with ordinary shares can be converted to a smart family investment company by accountants by changes to the articles and classes of shares, but it's best to set this up right from the start. Let me give you a very simplified example of a family of 4. The parents are 50 years old and have 2 children around 20 years old. Parents have total savings of £300,000 and plan to loan this to their company and buy 3 houses of about £100,000 each, total value £300,000. They have a 30-year long-term plan. They want to retire at 65 and then live at least until 80. They set up a family investment company with all the family as shareholders. The share capital of £100 is split 4 ways, but with the parents having a bit more, 51%, and children owning 49% in total. The parents inject the £300,000 as director's loan to buy the 3 houses. So the position at the start is that the net value of the company is only £100, as the £300,000 is a loan. The parents' shares are only £51. After 15 years, the parents have injected another £700,000 gradually as a loan from their savings. And there has been about £500,000 of net rent from the properties after taking out the corporation tax. Using these funds, the parents have bought another 8 houses at an average of £150,000 each. So in total, they have 10 houses by 2040, at which time each house has grown to £200,000 each, and thus the total value of houses in the company is £2 million. At this point, the parents are 65 and they decide to retire. They have a total director's loan to the company of £1 million, and the net value of the company is over £1 million. And all of this net value is owned in the children's shares, as the parents' shares remain at original value of £51. For the next 15 years, during their retirement, the parents take out in total £3 million in cash from the company as their pension income. £1 million is their own loan, which they take out without paying any further tax, and £2 million is the net rent the company received over this period after paying all the corporation tax. This £2 million of net rent has been taken out as dividends by the parents. Now, if the parents pass away at 80, then at that time, the properties have grown to £4 million. And this is the net value of the company too, as there is no loan outstanding. And all of this value belongs in the shares of the children. In this very simplified example, the shares of the parents have not grown at all, but they have managed to get £3 million pension income during their retirement, including getting back their loan of £1 million. The end result is that the children have inherited £4 million worth of assets without paying any inheritance tax. The other common problem is that parents want to shield their children's wealth from divorcing partners when relationships do not work out. In such a case, the family investment company can be combined with a trust, which would be set up to protect the shares of the children. The parents can own the children's shares legally as trustees, but the beneficiaries would be the children. This way, their child's wealth can be protected from the divorced partner. In the past, trusts alone used to be popular to reduce inheritance tax. However, taxes and rules have changed, and in my view, family investment companies are better than trusts for most investors, but the two can be combined as explained above. The benefits in saving inheritance tax are very clear, but what are the issues with family investment companies? Well, firstly, you need to have a long-term plan to transfer wealth to your children. If you don't want to do this, then there's no point in setting this up. There are high setup costs as you need to use property accountants who are familiar with setting up family investment companies, several £1,000s to set up. And remember, as always, any future government can make changes to tax law and rules, so long-term plans may need to be changed. And finally, with this system, the children may end up paying higher capital gains tax. So in summary, these are all the important points to consider when setting up a company to own investment properties. Please watch the message from our sponsor at the end. Thanks for watching. I'm Dr. T, and this is How to Invest in UK Property.